Hello friends, in a world of investing, we often consider good investments require great understanding of business on various verticals. Mostly, people analyze any business on 5 key criterias. Moat of a company, which can serve as a competitive advantage of a business. Its financial evaluations or its profitability. Future prospects of a company. What valuations business is currently available at. And finally, its management. Many investors also assess economic conditions before making investments. They in fact undergo complex mathematical and spreadsheet calculations. Some even read number of investment books. But we often miss an important aspect which majorly affect our investment returns. No matter how good we were on all of the mentioned criterias. That is nothing but our own psychology. How much returns we actually generates will also depend heavily on how we have behaved under various situations during our investment journey. We as a human being are quite emotional, and our mind plays all sort of games with us during our investment journey. We could choose to panic sell our good investments on market crashes without any rational thinking. Or else we could get into a FOMO of buying anything giving an extraordinary returns, just because we don't want to miss a boat. These decisions are unconsciously taken by our brain, and have a severe impact on our investment returns. Therefore, psychology opens up a whole another dimension in a world of investing, where you will be dealing with various psychological factors such as greed, fear, FOMO, or regret. Hence, in order to seek a better understanding of this aspect, let's go through a summary of one of the most famous book ever written on this topic by author Morgan Housel. The Psychology of Money. Author Morgan covers various aspects of psychology through this book, which I have summarized into 5 most important takeaways. Let's go through each one by one. Takeaway number 1. No one is crazy enough. Have you ever wondered what it may have felt to people of 1930s, who went through a period of the Great Depression? People couldn't do anything but just watching their money being eroded almost every day, with no hope of recovery at all. Unemployment rising at a sharp rate at the same time. This generation has undergone a fear and pain for a decade. On the other hand, if we look at a generation of 1990s instead, they have enjoyed a tech boom of an internet era, which was one of the greatest bull market of all time. Their life was filled with joy and they in fact went through an emotion of greed and FOMO. Now when it comes to the world of investing, approach of both of these group of people would have been very different from each other. Generation of 1940s, who are still recovering from an utter pain of decade-long depression, would have been extremely cautious on instruments they are investing their money in. They may choose to keep their money as a cash in bank with certain fixed interest, or in government bonds, since their first preference now will be of capital preservation. Whereas a generation who went through a tech boom of 1990s may feel more sense on keeping majority of their capital on stock market instead of low return assets. Well, these two set of people may consider each other being crazy for different choices they made, but that's not actually the case. Both are rational on their own way. Author Morgan believes that no one in the financial world is crazy enough for a financial decision he or she makes. So as a key takeaway from this lesson, you must focus on building your own investing methodology, instead of simply copying someone else's investing approach. Let's say there is investor A who prefers 80% over equity and only 20% on bonds, whereas on the other hand there is investor B who is more sophisticated and has less risk appetite, should have around 50-50 bond equity portfolio. Takeaway number 2. Never enough. Do you know, the Pyramid of Giza, in Egypt was the tallest building before 1300s. Few hundreds of years later, somewhere around 1500s, Cathedral of England became a tallest building on earth. Then came a world of modernization, leading to build more and more infrastructure. This led to build something like Eiffel Tower being the tallest building around 1800s. While we reach out to an era of 1998, spot of being a tallest building was captured by Malaysia's Twin Tower. Whereas if we talk about today's time, spot is obviously being held by Burj Khalifa of Dubai. What do you think? Is it going to end here? It actually isn't. There is already a project ongoing, with a name Kingdom Tower, which will hold a record of world's tallest building in coming years. You get the idea, right? It's a never-ending story. People tend to do something similar with money. One of the most dangerous emotion humankind has ever developed is an emotion of greed. We often are a victim of such an emotion when we keep changing our own financial goals. No matter how much money we generate, we always strive for getting more and more and more. This is often driven by social comparisons and being envy of others' success. It often leads us to be involved into taking extremely risky and unfavorable bets, such as getting too much involved into futures and options, penny stocks, or cryptocurrencies, to achieve those never-ending goals. Author Morgan also shared a personal experience of a famous person, Rajat Gupta. Born and brought up in one of slums of India, coming from a very humble background. What he went on to achieve starting from there was just phenomenal. By mid-40s he was CEO of McKinsey, world's most prestigious consulting firm. He had a wealth worth of $100 million. He could have done anything in life. But what he wanted was not just to be a centimillionaire, but a billionaire, and that too badly. Due to which he got involved into illegal activities, such as insider trading, and went on to jail, ruining his career. He not only risked his $100 million, but his entire life for becoming something which wouldn't have made much difference to him. Now a question is, why does he did that? Answer is very simple. He had no sense of what's enough for him. Takeaway number 3. The man in the car paradox. Imagine a person named John who lives in an expensive mansion. He owns a luxury sports car and enjoys living a life like a king size. On the contrary, another person named Eric lives pretty decent life. He lives on a normal house of his own, owns a pretty decent car, stays humble instead of just being a show-off. Who do you consider to be wealthy between them? Let me guess, John, right? It's not your fault. We as a human have associated wealth with kind of assets a person holds, and consider them as status symbol. But what if I tell you, John has invested most of his savings as a down payment, and now has almost negligible investments. He in fact is actually drowning in a debt and paying several EMIs for his expensive house and car. Whereas Eric, who was living a pretty decent and humble life, has more than $10 million worth of equity investment, which is not only growing every year but also generating fair amount of dividend income for him. Who do you think is more wealthy now? Yes, it's actually Eric. Where John was kind of a show-off, even when he didn't had money to buy such luxury things. Eric, on the other hand, focuses more on his own financial goals, instead of showing off or comparing himself to John. Here is another example. What do you say when you see one of the finest cars such as Ferrari went past you? We often say, "What a car, I will buy it one day as well." Point here is, we never bother about who a driver is. Because all we are obsessed about is actually a car, and not a person having it. But without realizing this, we also become a victim of the same trap, and don't recognize that no one will bother about me, even if I have it in future. Hence a key takeaway from this lesson is to not treat materialistic assets as a status symbol. Author Morgan also mentioned another key point. That a wealth is actually what you don't see. As seen in our previous example, it was Eric who was more wealthy, even when John appeared to be wealthy. Similarly, there are other dimensions to the wealth. Wealth is not just a financial well-being, but it has various other aspects, such as a beautiful family whom you care for, health of a person to enjoy his life, friends for having fun. They all constitute a wealth of a person. Finance is just one pie in a cake. Takeaway number 4. The Seduction of Pessimism. Let's start with one of the famous quote from Peter Lynch, one of the greatest investors of all time, once rightly said, "Far more money has been lost by investors in preparing for corrections, or anticipating corrections, than has been lost in the corrections themselves." People tend to discuss or focus a lot on being pessimistic, trying to predict market crashes, just because it sounds so much intelligent and different than an obvious of being optimistic. Optimism sounds like a sales pitch, whereas pessimism sounds like someone trying to help you. Media also sensationalize fear among people, since it's easier to sell that kind of a news instead of just being optimistic. Imagine a scenario where an investor, named Sarah, closely follows news reports predicting an imminent economic downturn. These reports highlighted various negative indicators such as slowing economic growth, geopolitical tensions, etc. As Sarah absorbs these pessimistic narratives, she becomes increasingly anxious about the state of the economy and the potential impact on her investments. Fearing significant losses, she decides to press that big sell button, where she sells off a large portion of her stock holdings and move her investments into safer assets like cash or bonds. In the following months, Sarah watched from the sidelines as the stock market continues to rise, fueled by strong corporate earnings and positive economic data. Despite missing out on potential gains, she remains convinced that her decision to sell was justified by her concerns about the economy. This example illustrates how the seduction of pessimism can lead investors to make decisions driven by fear, rather than rational analysis. Therefore, as a key takeaway, it's better to just being prepared for economic downturns, instead of actually trying to time a market crash. Let's move on to our last takeaway: nothing's free. Let's say you want to purchase an iPhone today. You can clearly see a price tag associated with it, and purchase it by paying that price. But there are enormous things in the world which doesn't always show a price tag, but they actually do have price associated to it. For example, if you decided to focus on improving your health and fitness from today, what price does it carry? No, it doesn't need any dollars from you, but it still demands certain price. Price to be disciplined with your diet, price to exercise regularly, price to quit bad habits. Similarly, when it comes to the world of investing, you are investing your money in order to seek good returns, right? But what do you have to pay in return? You don't clearly see a price tag associated with it. Since its currency is not in dollar terms, hence it's not clearly visible, but as author mentioned, nothing comes for free. Investing also demands certain price. A price to handle market volatility. Price to not get carried away by social comparisons. To deal with a regret and uncertainty. To keep patience with your investments. A key lesson here is accepting such a cost up front. It will allow you to be ready to pay it when the time comes, rather than freaking out and quitting. So as a summary, the book made me realize that managing money isn't just about numbers and analysis. It's also about managing our emotions and behaviors surrounding money. This book has made an enormous difference on my investing journey so far. Hope it would do same for you as well. Hope you would have enjoyed a video. Please hit a like button and subscribe to the channel. Also, do not forget to hit the bell icon. Thank you for watching.